Welcome to the Basic Financial Analysis, Ratios and Performance Monitoring in Microfinance Banks. This is Part 2, Lecture 5 of the topic. In our last lecture, which was Lecture 4, we discussed the customer's profit and loss statement. Today, we are discussing ratio analysis. This is a very important topic in this series of our lectures. Don't forget we are still discussing this in the customer's account books and not of the banks. Customers have their own ratio analysis they are not aware of. They just don't know it because they don't know how important it is to their business, hence they don't use it. But for the microfinance institution it is very important that they understand it to understand the metrics of their customer's business. Now, let us begin. Our topic for Lecture 5 is Ratio Analysis for Clients. And now I ask, what is ratio analysis? But before then, we will be looking at ratio analysis under 5 subtopics listed below. 1. Ratio analysis for clients. Why do we need ratio analysis? How to generate ratios, sample exercise, and review question. Like I asked earlier on, I asked what ratio analysis is. Let us look at this step by step. First of all, what is ratio? A ratio measures the difference and relationship between values in other ways to make viable decisions. They are very significant for measuring a client's business performance over a period and is generated by dividing the numerator by a denominator with the result being expressed as a percentage. A monetary value, days or numbers. Why do we need ratio analysis? It helps us make viable decisions on loan approvals, it helps us understand the type of risk involved in the client business, it interprets client's business performance better, it proffers how best to mitigate risk that may arise during course of business, it clarifies the relationship between previous reports. The next thing we are going to be talking about is how to generate ratio. In order to adequately access a client's business to determine its net worth and take decision on loan granting, microfinance analyst is expected to understand the listed ratios below: liquidity ratio, turnover ratio, debt ratio, profitability ratio, and repayment capacity ratio. You don't expect a microfinance institution to have a repayment capacity ratio when he is not repaying a loan as a customer. This is the main reason why all these categories of ratio focuses on the customer's book. While understanding the above ratios, it is important to note that the results generated are a use or combinations of one or more book of financial statements which are key elements in determining these results. To determining a client net worth and performance would require use of items in the client's balance sheet and the profit and loss only. Why do we need ratio analysis? While understanding ratios, it is important to note that results generated are as a result of the use of one or combinations of financial statements which are key elements in determining results. Determining a client net worth and performance would require use of the client's balance sheet and the profit and loss ratio analysis table. This table shows how ratios are examined with a combined use of both the balance sheet and profit and loss statement to learn about its liquidity, operational efficiency, turnover period, repayment terms, and profitability. It uses a combination of metric to analyze a variety of financial data about a customer's book or company. To better understand the ratio analysis table, we will have to understand the contents therein. Starting from the types down to the formula, we will need to understand how they work to achieve the synchronization it desires. Highlighted in green, we start with the liquidity ratio. This is the value of current assets, divided by the value of current liability. These are both gotten from the balance sheet. The next is turnover ratio. This is the value of the cost of goods sold, gotten from the profit and loss, which is then divided by the value of the inventory gotten from the balance sheet. We go over to the turnover ratio days. This evaluates the value of the inventory in the balance sheet, multiplied by the numbers of days sales will likely occur divided by the value of the cost of goods sold, gotten from the profit and loss account. Next is the turnover ratio days plus new debt. This shows the value of the inventory in the balance sheet plus the value of the new loan to be granted multiplied by the numbers of days sale will likely occur, divided by the value of the cost of goods sold and gotten from profit and loss. We now move on to the debt ratio where we analyze the value of debt to equity. This is the value of total liability divided by the value of equity. They are both extracted from the balance sheet. The debt ratio still has an arm where we determine an additional debt added to the current loan position. This is known as the future debt to equity ratio. This is the value of debt in addition to the proposed new loan gotten from the balance sheet. Divided by equity gotten also from the balance sheet. Our next discussion is on profitability ratio. It shows the value of profit which is got from the profit and loss statement, multiplied by 100 and divided by the total sales that were gotten from the profit and loss. Finally here, we look in the repayment ratio. This is the monthly repayment installment value divided from the total disposable income, both derived from the profit and loss statement. If you have been following this lecture, we studied both the balance sheet and the profit and loss in lecture 3 and 4 respectively. Below tables are answers gotten from the previous example we used, and we are continuing to use them here. So, if you want to understand how we got here, please refer to part 2, lecture 3 and 4 for more information. I have placed the link of these lectures in the description link below. Now, let's continue. Using below example as culled from our last lecture. It shows a customer who requests for loan of 300 with monthly repayment of 60,000 monthly for 6 months. The information on the balance sheet and the profit and loss has been used to populate the books of account. Using both customers' books of account, let's find the ratios of the current ratio, inventory turnover ratio, inventory turnover days with new loan request, debt to equity ratio, future debt to equity ratio, return on sale ratio, repayment capacity ratio, before taking on this exercise. Note that the statement of financial position with the balance sheet and the income statement with the profit and loss are used interchangeable. Also, the focus of this lecture is for microfinance professionals to understand how to properly analyze ratio analysis. This concludes our lecture for lecture 5. See you in lecture 6, as you can go ahead with finding the ratios in the exercise below.